Hello, this is Professor Busiri Booth, and this is part 3 of our weeks 3 to 4 wrap-up. In this video, I will focus in on options for organizing a business, as well as offer my thoughts about why individuals start businesses. All right, so according to the Small Business Association, there are general standards on what can be considered a small business. There are exceptions, of course, but generally, it should have less than 500 employees for most manufacturing and mining industries, and about 7.5 million or less than that in average annual receipts for many non-manufacturing industries, and these are generally the services. And then there are specific size requirements if you are going to pursue government contracts, and you can find that when you by going to the SBA or the Small Business Association official website. So let's talk about the different kinds of formations, legal formations. And before we do that, let's take a look at generally how these are distributed across the United States. So as you can see here, the pie charts are divided up according to receipts, number, and net income. And the blue part are for sole proprietorship, which we'll talk about what those are, and then partnerships for the sort of reddish area, and then for corporations or greens. And as you can find that the corporations really do make up for the vast majority of receipts and net income. Net income is basically after all costs in the United States. So they really do make quite a bit of the revenues, make up for a lot of the revenues in our economy. And then you can see that partnerships then also come second to that at 15% of receipts and 25% of net income. And what's interesting though is that the sole proprietorship make up the most of that pie in a number of businesses that are considered sole proprietorship. And that sort of makes sense. I mean, corporations in general and partnerships are just made up of more people as an entity, individual entities, and sole proprietorship by its very nature are individuals. All right, let's talk about each one of these. And your book does a pretty good job about discussing, in detail what each one of these are. So I'm just going to go over some general ideas, general concepts. So the sole proprietorship is one owner, and it is taxed as the individual level. So if a person makes money and they are a sole proprietorship, they basically report their income through their own tax filing, and that the liability, however, is unlimited, meaning they are fully liable for any kind of liens on their activities. Not just liens, but they're fully liable for the entire business. And this is, of course, owned by a single individual. And it's the easiest way to conduct business because you don't even really, at least in the state of Washington, need to file any papers. You could just start selling, things, say, over the internet or at Sunday markets, for example. So then let's talk about partnership. And partnerships are two or more owners, and they are also taxed at the individual income, like a sole proprietorship. But there are some limitations on what they're liable for, and they're also easy to form and to conduct business. And the next general formation is a corporation, and that could be made up of any number of shareholders, and those are people that have stake in the company, and they are taxed at the corporate entity, not at the individual entity. And the liability is limited to the investment that they have put into the company. So their own personal, wealth cannot be, are not tied to the corporations, are seen as two different persons, in fact, and that the legal entity are the shareholders or the stockholders. And the S corporation It's a kind of corporation. It's just called S corporation because that's how it appears on the IRS tax code. And this has limitations in the number of shareholders. They can have up to 100, and they're taxed like a partnership, as you see here, taxed like a partnership, and that their liability is also limited. And there are numerous legal tax advantages, and however, there are restricted shareholders, and we'll talk about that in a moment. And then there is the LLC, the limited liability company, and you could have unlimited number of shareholders here, but it is also taxed as a partnership. There are protections on liability. Again, your personal assets are not subject to liability concerns, and so you could avoid personal lawsuits, for example. All right, so let's talk a little bit more about sole proprietorship. And those are, again, businesses owned, operated by one individual, and it's the most common in the United States, and mainly focused on services rather than manufacturing, like, if you were to open an espresso bar or a restaurant, that sort of thing. And they typically employ fewer than 50 people, sole proprietorships, and they make up nearly 3/4 of all U.S. companies. So if you were to go to Etsy, a lot of those are sole proprietorships. And the women business owners that are sole proprietors are less likely to get access to credit. And it's an interesting fact that that our society is trying to address, but that's regrettably the case. It's not insurmountable, but it is generally the case. So, and some advantages of that is that it's very easy to form. Again, you can just decide today you're going to start selling, and you start doing that. And there's a high level of secrecy because you're not required to file any forms about your business other than, you sort of report your earnings or losses, and that you keep all of your profits. You don't have to share that with anyone. And because this is, you're the only individual responsible for this business, you have great flexibility and control of the business. So, and the government regulation is quite minimal. And you pay taxes only once. So once you make your earnings, it goes through your, filing, and you pay taxes only once. It's a little complicated to think about that in terms of corporations, but just keep in mind that in this case, taxes are paid only once. Okay? And it can also be dissolved quite easily. You can just say, I'm done with this. I'm going to do something else. And then that's that. All right? And then there are, of course, disadvantages. And among them is that you can be sued pretty much for everything you've got. And that's, certainly not fun. And then, of course, because you are the only person providing the funding, there are very little external funding that you can tap. And that if you are the only one running the business, you pretty much have to provide for all the skill sets, or not all, but the majority of sort of the management skill sets, strategic and tactical or otherwise, because you're the only owner. So you're the only one basically responsible for that business, and that the success is tied to the owner, right? And that it is really difficult to find qualified employees when you're sole proprietorship, because it's very difficult to compete with corporations and their package for compensation, which includes benefits, for example. And that generally speaking, sole proprietorships do pay at a higher tax rate level. Okay, and there are, like I said, greater difficulty in attracting employees for the reasons I mentioned earlier. Very difficult to compete with, bigger coffers. Okay, and there's little advancement within the sole proprietorship. So, of course, you keep all the profits though, and then you would also assume all the risks and the financial obligations. So there's your cost-benefit analysis there. And then the partnership is that, of course, you have two more people, they're co-owners, and they minimize the disadvantage of sole proprietorship and maximize the advantages in this sense, because if you have a partner, the idea there is that you both sort of a stake in the company, so you put some funding into it, some capital, in that you bring in different skill sets. So one person may be very good at accounting, another person's really good at marketing, and so that's a good thing, because it's rare for one person to be good at everything. And they're typically larger than sole proprietorships, but much smaller than corporations. Okay, and there are different kinds of partnerships. I'll just go very quickly here. One is called a general partnership, where people could enter the partnership having sort of complete sharing of both management and liability of the business, and so they share the same amount of responsibilities and liability. And the limited partnership is where one of the general partner assumes unlimited liability, and then there's a limited partner that says, well, I'm only going to put this much into the company, and my liability is and my ability to make decisions around the business is sort of limited to my investment. It's a proportional amount of my investment. Okay. And that generally partnerships will have what's called articles of partnership, which are legal documents, and they articulate the agreement between the partners. So it makes sense. And then there are advantages. Again, they're easy to organize. They have availability of capital and credit, more than one person, and great credit can go to the bank, for example, and get a loan. They have diverse talents, and they can make decisions relatively quickly. And again, government regulations are few. With any kind of formation, there are, of course, disadvantages. Partnerships still have unlimited liability in many cases. There are some limitations, but generally speaking, are just very exposed, meaning your personal assets as well as the company assets are exposed to liability. And they are responsible for each other's decisions. So if you had a partner and decided to sort of check out, leave the state, and they're still a partner on paper, you are responsible for that person's responsibilities. You're seen as the two of you as one. So that's not a good thing if you haven't partnered with someone who, in this case, did not fulfill their obligations. And then if there is a new partner, then you'll have to go into this process of making partnership changes, changing your articles of partnership, and it's difficult to sell a partnership interest. It just is. And the distribution of profits maybe even, and it's not uncommon for partnerships to begin as friends and end up as enemies. So it's really really important to have those legal documents sort of articulate what the partnership is about, who is responsible for what, and how the partnership can be dissolved. And if those agreements are made up front, then it is far less likely in the end to end in unfriendly terms, because the terms have already been established in the beginning. All right. And then, and there are, again, it's difficult to find external funding like large corporations. You basically sort of depend on each other to bring money in, and on the bank. All right. And then they are quasi-taxable. They do not pay taxes per se, because they are, but they not like corporations, but they do file tax returns. Yeah, because they are taxed at the income, at the personal level, and that they do, and partners report the share of the profits, and they pay taxes at that income tax rate for the individual, which is also often higher than if they were the corporate tax rates. So there are key considerations. I'm just going to note 3 of them here. Your book, again, does a pretty good job. But if you are going to go in a partnership, it's very important to ask yourself why you have a partnership. And one of those ought to be that both of you bring different skill sets into that partnership, so that you can leverage each other's strengths. And that it is very, very important that whoever your partner is, and you can effectively communicate through good times, bad times, uncertain times, because running a business can be very difficult. There are many ups and there are many downs, and miscommunication can really ruin a good thing. So it's important to have processes for effective communication, and then to have realistic expectations around resources and processes around financial management. many good ideas have fallen flat on their face because people did not know how to manage their resources. So it's really important to have that considered and figured out, and also particularly at the partnership level, because it involves people, and sometimes often those people are your friends who come into partnership with you. Okay, and then now let's talk about corporations real quickly. This is a legal entity created by the state. You can't just create a corporation. You actually have to file papers. It may be expensive depending on the state, and to make sure that the liabilities are separate from the owners. So the personal assets and the corporate assets are separate, and those have to be articulated. And interestingly enough, corporations have relatively many rights, of the same rights, duties, and powers of a person. This is why the U.S. Supreme Court sort of regards corporations as persons, because they can own and transfer property. Person can own and transfer property, and they can enter into contracts. They can sue and be sued in court, and there are other rights as well. And these are, corporations, as you saw in the pie charts, make up the majority of all U.S. sales and income. So they're huge impact in our economy. And they're typically owned by many individuals and organizations and who own shares of the business. And those shares are called stocks. They can be bought and sold, and they can be gifted or inherited. And they can also earn dividends. Not all stocks give dividends, but many do. And these are profits of our corporation. And so when a corporation makes profits, it gets it back as dividends to its shareholders and distributed as cash payments. Okay, and who creates them they're called incorporators, and they follow state chartering procedures. They file their legal articles of incorporation within the state where they chartered, and then they get a charter from their state, and then they have to establish bylaws and elect a board of directors. This is a requirement. And there are examples of corporations. These are common. There are smaller corporations, larger corporations, but the corporations that you see here, at least 50% of their revenues are outside of the U.S. So GE, GM, General Motors, IBM, these are familiar names, McDonald's, and Procter & Gamble. These are the larger ones. Okay, there are also something called private corporations. The one you saw were public corporations. These are private corporations, and they're owned by a few people who are closely involved in managing the business. They're typically family corporations, and their stocks are not sold to the public, and they are not required to disclose financial information publicly. And then there are a corporation can decide to be a public corporation, and they go through what's called an IPO, an initial public offering, where they sell their stocks to the public for the first time. And they typically do this to raise capital so that they can expand. That's typically the reason why they do that. So there are different kinds of public corporations. The public ones, like McDonald's, GM, and the like, and whose stocks can be bought, sold, and traded by anyone. There are quasi-public corporations, and they're typically owned and operated by the government. They provide a service and often operate at a loss. And I believe the USPS is a quasi-public corporation. And then there are nonprofits, and those basically focus on service rather than making a profit, and they are not owned by the government. And there is a misconception, though, that nonprofits somehow lose money or they don't make money. It's just they don't focus on making money. They just reinvest their revenues into the organization so that they can provide their services, expand and enhance their services. And again, they're not owned by the government. All right. And one thing to keep in mind is that corporations have to have a board of directors, and these are elected by the stockholders, basically to oversee the operations. And these board of directors are responsible for long-range objectives, and they're responsible for meeting them on time, and they're legally liable for mismanagement or misuse, And one of their biggest tasks, the most important task, is to hire the corporate officers, like the chief executive officer, the CEO, the COO, the chief operating officer, the chief marketing officer, what we call the C-suite. All right, so just something about stocks. There are generally two kinds of stocks, and the two basic, kinds of stocks. One is called the preferred stock, and these are owned, the owners have a claim to profits before other stockholders do. And so Warren Buffett, for example, mega billionaire, typically has preferred stocks. Okay, you have to have a certain amount of wealth to be able to participate in the acquisition of preferred stocks. And then there are common stocks. That's like everyone else. Owners have voting rights, yet do not receive preferential treatment regarding dividends. So, preferred stocks have that preferential treatment. And common stocks, folks, when you own a stock, you are a voter, but you could also vote by proxy, assign somebody else to vote for you. And you also have preemptive rights, and you can buy any shares of stocks the company issues. That's what preemptive rights mean. And then there are advantages to corporation. Limited liability, again, a separation between personal assets and business assets. There's a relative ease of transfer of ownership. You can just sell your stocks. Corporation can live forever, and it's a lot easier to secure funding than other forms of businesses, and that there's great potential for expansion, particularly because you can get the funding in order to expand. There are also disadvantages. For example, corporations are subject to something called double taxation. It's a little complicated idea, but basically it is when their income taxes are paid twice on the same source of earned income. So, for example, when they report profits, they are taxed at the corporate level, and then when they issue those stocks, those are also taxed at the personal level. And in terms of international trade, the same income can be taxed in two different countries. And it is also expensive to form. There are many more processes involved in putting together a corporation. There are also disclosure requirements to the government and the public, and brings a lot more scrutiny and also accountability, as well as there are owners and managers who are not always on the same page and can have different goals, which can lead to hostile takeovers. So hostile takeovers are very real. And that is when an individual or a company attempts to buy majority share, and the purpose and the majority share of stocks. And the sole purpose is to structure the management team because they're not happy with the direction of the company, and also to elect a new board of directors. And these are very different from mergers and acquisitions because there are no mutual agreement for the transfer of company ownership. That's why it's called hostile. And if a company felt it were vulnerable to hostile takeovers, it will sometimes do what's called institute a poison pill. And what it does, it dilutes the value of the company of stock by issuing stocks at a lower, stock price level, lower valuation, to make it less attractive to hostile takeovers. And, it obviously will decrease the value of a takeover. So it's meant to be a deterrent. All right, so then there are S corporations, and S corporations are taxed like a partnership with restrictions on shareholders. Again, you can only have up to 100 shareholders, and it eliminates this double taxation problem that corporations find themselves in. So double taxation, again, is a rather complicated concept, and if you want to learn more about that, please consult not only your book, but other resources. But suffice it to say that corporations in general don't want to be taxed twice, and the S corporation basically eliminates this, this hang-up. And it is very popular with entrepreneurs, representing nearly half of all corporate filings. Okay. And then there's the LLC, and the LLC basically provides, again, limited liability and taxation, like a partnership, but has fewer restrictions on members, and is considered a blend of the best characteristics of all of these different formations. So corporations, partnerships, and sole proprietorships. And if you were to consider having, owning a business, be very careful to expose yourself to liability. At minimum, you need to, in my opinion, you need to set yourself up at the very least as an LLC. You can always change your legal formation, as the new fiscal year starts, but make sure you protect your personal assets from what can happen in the marketplace that you just can't control, or difficult control. And there are other formations your book goes over. I won't go into this too much, but there are things called a joint venture. These are two legal entities coming together to form partnerships, and they're generally for a specific project for a limited time. And levels of controls have a lot to do with the agreement themselves. And they're generally popular when it comes to large investments, say when you go into a country and you want to partner with a company within another country, and you're coming in with your own resources, and they offer sort of access to markets, and you offer operational excellence and product excellence and the like, and then you work together to sort of penetrate the market, and just going to get started, and then have agreements about how to move forward from there. So generally, this is used in the development of new products. Okay, and then there are also something called cooperatives or co-ops for short, and these are individuals or small businesses that come together to reap the benefits of belonging to a larger organization. So there are still, they're individual businesses that decide to come together. And the setup is not to make money as an entity, as one entity, but is to focus on the members being profitable or to save money. So they leverage, some of their systems and their marketing and their ability to, negotiate venues, for example, like where they're actually gonna house their and offer their products. And so some examples of these are like the Washington Farmers Co-op. It's locally owned by approximately 750 member farmers. And again, these are individual farmers who come together to band together to reap the benefits of being a larger organization. An REI is also a co-op, and it's a little bit different in that it's owned by consumers. So the formation of businesses have certain considerations. Among them are the stage of the venture, the need for liability protection, the need to access capital and therefore to expand, and then just ideas around the nature of the business and how long the business will be expected to exist. So the stage of venture, for example, might have to do with, if you're still in the development of your product stage and you don't really have a whole lot of penetration in the market, it may not make sense for you to start out as what's called a C Corp or just a regular corporation, and instead start out with an LLC. You can certainly progress forward through the different formations as your needs change. And of course, our liability concerns, and those are always important to figure out because you want to limit your exposure to liability, particularly at the personal level, and limit it to the investment that you have in the company. And then in terms of capital and expansion, certain formations allow you to gain access to capital more than others. And then, for example, if you're just looking for a joint venture because you already have an existing company and you just want to partner up with someone during another company for a limited amount of time, the joint venture option becomes interesting and offers itself some protections. Now, let me offer some thoughts about why a company start a business. You could start, your top 20 reasons, top 10, and what I found here was a succinct list of your top 5, which really sort of capture anything that you might think about why, generally speaking, an individual or group of individuals might start a business. And one of which is, of course, to make money, income potential, right? Or they might have a passion. I love to bake pies, that sort of thing, and I have a really good idea about how to do that, and or I want a certain lifestyle. I want to only work at certain times of the day and certain times of the week, or I want to be able to, play golf eventually and take trips around the world, or I have a need to self-express. These are among the reasons why people start a business. And there are those individuals, though, who have studied businesses a lot, and one of which is Michael E. Gerber, and he wrote this book called The EMyth Revisited: Why Small Businesses Don't Work and What to Do About It. If you are serious about starting a business, I highly recommend you read this book. It's a very quick read and lots of great wisdom in it. And one of the things that he does is addresses this myth where entrepreneurs start businesses with a truly transformational idea to change people's lives, to make it better, and in a way to do it that no other company has provided. And what he has found is, through his research, is that the reality is something more like, these are technicians who are suffering from what he calls an entrepreneurial seizure. And the thought process goes something like, I could do a better job running a business than my boss, so I'll go ahead and start a new business. And what actually does happen, and this is rooted in this misconception that knowing how to do the work, say how to bake pies, is somehow the same as how to build and grow a business that does that work. And so that's a major misconception. And one way to address that, is to get educated. If you're really serious about succeeding in business, you want to study certain subject areas like economics and microeconomics, sort of the study of supply and demand, sort of the inner workings of how market spaces work. Macroeconomics, the larger forces at play, like how interest rates affect how much your business can actually make and how come people are more willing to buy certain things during times of, of the year or seasons because the dollar is stronger or not the dollar is stronger. And then you also want to make sure you have a plan for accounting. And accounting, I'm not suggesting that you become an accountant. I am suggesting that you understand the principles of cash flow. Money's coming in, money's going out, and how to manage your limited resources and have a plan to do that. And then, of course, management is really, responsible for sort of the planning, the tactical and the strategic planning of meeting the business's objectives and organizing, the kinds of resources you need to make that happen, and leading the people and to motivate them to achieve those objectives, and ultimately also to have certain controls in place so you don't get in trouble with the government, you remain compliant, and that you have a strategy on addressing changes that will inevitably come in your business. You may not be able to anticipate the kind of changes happening, but you can expect that the norm in business is that there will be changes. And so that's the role of management, is really to kind of anticipate that. And then there's this greater area called marketing. And marketing, in summary, is really the idea of creating, communicating, and capturing value. And if you don't really understand what that means, you may be producing a product that you like and you think is really just great, but very few people in the world share the same thoughts about, or that it is great, but you're having a difficult time communicating that value, and so therefore you'll have a hard time capturing that value in terms of revenues. And then it's really important to distinguish among the roles of technician, the person that knows how to do the baking of pies, the manager who knows how to do the day-to-day operations, and then the entrepreneur who sort of considers the larger challenges of growing the business. Those are three very different roles, and you may not be able to occupy, all at once those roles. You may have to eventually hire a manager at this day-to-day operation, and as a business owner, you really are, the entrepreneur thinking about how you can sustain, enhance, and grow your business. And there is this very important idea where you have to understand the difference between working in your business, where you're slaving away doing the day-to-day operations, baking your pies, starting the day and closing the day, and you do everything in between, versus working on your business, where you're developing plans and systems and processes so that your business becomes dependent on the system versus on you in order to operate, so that you can then realize and reap the benefits of why you started a business in the first place, which is to have the kind of income that you need in order to, say, for example, support the lifestyle that you wanted to have, or have the time to get your good idea to become better, and so that you can fully self-express. And if you are serious about business, I would highly recommend you consider taking some kind of small business planning course like Management 284. I, along with other instructors, teach that course throughout the year, and where you will learn several aspects of what we talked here. And I highly recommend also that before you take that course, that you have some familiarity with econ, with some kind of accounting and marketing, so that you can fully benefit from a course like small business planning. So this ends part 3, and I thank you very much for listening, and I hope to see you, so to speak, again soon. Thank you.